Today we're going to be talking about a very interesting space, the banking space and the small finance banks in particular. Some of the smaller banks rather, not small finance banks, but some of the smaller banks will likely be in focus because you will see improving asset quality going forward. You've got that MFI and unsecured pain which will likely go behind them, and some of them trading at a one-time book could well look interesting, and one of those candidates is a CSB Bank. Of course, that's the stock price over the last 12 months. That's a 24% return that they've clocked. But from the highs of the year, it's come off quite sharply. We'll try and get a perspective on what lies ahead. Why CSB Bank? A couple of other points that I want to quickly highlight. One is it trades at a 1.1 time book, as you can see on your screen. The second piece is they are penciling in a growth of 25% plus all the way through FY30. The guidance is they'll reach a 1 lakh crore loan book size by then. They're building to scale starting FY27. So there's a strategy they put in place in FY22, which extended all the way till FY30. FY27 is that year when they start to scale, and that will likely be an inflection point, and therefore this becomes an important conversation to have. Also, there were some hiccups in Q3. Are we expected to see a better Q4 therefore, and how should that play out will also be part of the conversations we have. Let me start off by giving you a perspective on what the bank is and what it has done over the last few years. In terms of the incorporation, it's a 1920 incorporated bank, so it's got a very long history. It's owned by the Fairfax Group currently. It owns 40% of the bank. It's a private sector bank with a larger focus on southern India. That's really the domain it currently looks at this point. And when you're looking at some of the other pieces in terms of the loan book size and the like, we'll quickly highlight that. In terms of products, gold loans is around 51% of the loan book of the bank. 24% is wholesale loans. Business lending group, MSME and the like is around 12%, and then you have retail at 13%. Some of this has switched quite sharply. We'll try and also understand that as the bank scales, how will this loan mix therefore evolve? Let's also look at geography. The current loan book is present largely in South India. 70% of the loan book is tilted towards South India. One of the strategies between 2022 and 2026 was to tilt the loan book more towards India. That has happened. I don't know if it has happened to the best of what the management has expected, but nonetheless it has happened, and you can see that loan book tilting towards Maharashtra, for example, which is now 11% of the book. There are also others within that pack outside of the southern states of Kerala, Tamil Nadu, Andhra and Karnataka. Now, let me talk about the branches. The branch tilt is very similar to the loan book tilt. It's got 846 branches, 818 ATMs and other touch points that they have. But what really stands out is the similarity in terms of the mix between the loan book and the branch mix as well. It's absolutely the same when you're looking at the numbers in terms of the mix. 32% of branches sit in Kerala, 16% in Tamil Nadu, 13% in Andhra, 11% in Maharashtra and 7% in Karnataka at the end of Q3 FY26. This is those numbers. Now let's look at the P&L and some of the metrics that we always analyze in this show. When you're looking at the net interest income, it's grown at 9% because there's been margin compression. So the balance sheet has grown very, very well, but margin compression has led to the net interest income growing at a slower CAGR. But that has kick-started in FY26 in terms of the net interest income growth. That's been strong in FY26, and we'll look at those numbers. Second piece is with regard to operating profit. That's grown at 14% CAGR. This has been choppy as well. We'll talk a little bit about this, given tech spends and other spends which the bank has done, has left this number slightly choppy. The provisioning number has been absolutely benign. So this is where the bank has really scored points. It's been very, very solid in terms of the provisioning. And last off, with regard to profit growth, therefore, that's only reflected a 9% profit growth because of that slight compression that's happened because of the provisioning that happened in FY25. The slight compression in profit after tax, therefore, has led to only a 9% CAGR. But outside of that, it's grown in a fairly healthy clip. In terms of the Q2 and Q3 numbers, you've seen decent growth on NII, 16 to 21%. Operating profit has grown at around 30 to 40%, and profit after tax has grown at around 15% odd for that period. Now, this is the loan book size. You just look at the way in which loan book has grown. It's grown extremely fast, and that pace is at 26% CAGR over the last 3 years. The deposit growth also has been solid, 22% growth, of course, slightly benign, and versus the loan growth, of course. but it's got a decent liability franchise, especially in that southern India market. What are they doing outside of that is what I'd want to understand. Also, CASA is what I'd want to understand, because cost of funds is elevated for this one, which is pressuring margins. You look at capital adequacy ratio, it is currently at 19.4%. So a decent capital adequacy, which allows it bandwidth to grow. But when is the next fundraise? That's something we'll understand from management as well. In terms of operating metrics, you'll see a trend down with regard to margins. Margins was so solid, it's trended downwards. We've started to see an inch upwards in terms of margins. That Q2 FY26 margin number is not 4%, it's 3.81%. So that needs a change. But outside of that, we've seen a margin uptick in Q3 as well. You're looking at cost to income, which is choppy, as I said, some tech spends and some process-driven spends, as one would call it, as you build a bank, has happened, and that has played out on that OPEX number. Where does that go? Will be interesting to see and understand as well. ROA has therefore been slightly on the choppy side, and therefore we give this a neutral because of the margin trends and because of the OPEX trends. But outside of that, you see a consistent 1% plus ROA across the board, sometimes even hitting 2+% in 1 or 2 years. And that's what you're really seeing in terms of the ROA trends. Steady in terms of credit cost, because that's the only big disruptor on ROA when it comes to banking companies. When you're looking at yields, they're roughly 10 to 11%. That's the kind of yield on the bank. 50% of the book is tilted towards gold, mind you, viewers. So that's something you want to keep your eye out on as well and understand better, because gold loan rates are slightly elevated in that sense. And that kind of cushions that yield on advances number. When you're looking at cost of funds, though, that's where a better part of the concern lies. You've got a 20% CASA ratio, and therefore the cost of funds for a bank like this has inched higher in this cycle, which has compressed margins to a slightly larger extent than I would expect the management to have anticipated. And that is really the concern. But that could unwind, because there is a deposit growth strategy starting FY27. We'll understand what the downsides to that strategy could well be. Last off, when you're looking at the NPA ratios, here's where the bank scores points. Sub 2% on the gross NPA number, despite a tough quarter in Q3. That unwind likely to happen in Q4. But nonetheless, it's a sub 2% GNPA trend across that cycle. When you're looking at NNPA, it's even better. It's sub 0.7% in terms of NNPA across the cycle. So that is where the bank has impressed. And that is the positive, really, in terms of the asset quality performance. Let's talk about return ratios. And when you're looking at the return ratios, at one point it was clocking 20% plus. It tapered down towards the mid-teens. Now it's sunk below mid-teens. That doesn't look too pretty. Can they turn that around? And mind you, the capital adequacy ratio also falling, so they might need a fundraise. I'm trying to understand how they're going to balance both of those. The ROEs along with the capital adequacy, which needs protection through a fundraise. So we'll try and get a perspective on that as well. In terms of shareholding, 40% holding by Fairfax India, which is the India holdco for Fairfax Holdings, which is the Canada entity. That holds 40%. There are very interesting investors within this basket as well, including the likes of an Amansa. Yes, Akash Prakash holds roughly 10% of the company as well. So you've got some interesting names in that mix, and therefore this one looks interesting. But mind you, they'll have to dilute. Promoters will have to dilute down towards 26% over the next 10 years, but they've got that bandwidth to do that. So over maybe the next decade or so, they'll have to dilute that number down from 40%. That's the only possible concern. But likely, when you're growing so fast, the fundraise takes care of that. So we'll try and get a perspective on that as well. Last piece is with regard to valuations. Let's quickly look at that. Your price to book currently sits at 271 rupees a piece. The market price around 360 rupees a piece. When you're looking at the current price to book, it's at around 1.32 times. Looking at FY27 price to book of around 1.05 times. So around 1.1 times book 1 year forward. And you've got, for perspective, your EPS for FY25 was around 34 rupees. So it roughly trades at 10 to 11 times earnings, which is not exactly expensive for the kind of steadiness that the bank provides. When you're looking at analyst coverage, there are 8 buy calls, no holds, 1 sell, but there are some smaller names because the bank is a sub 10,000 crore bank, and therefore we've been cautious here. We've given it a neutral just because the coverage isn't as vast as one would anticipate with smaller companies, but a 34% upside is what the average analyst is penciling in. So a very strong upside is what is currently being penciled in. In terms of management commentary, well, their strategy 2030 is what they've worked on. I'll quickly build that out for you. Sustain and build was really 2022 to 2026. They built a tech platform, they've enhanced their product portfolio, they've enhanced liability franchise, they've focused on gold loans, and they've built a risk management framework. That was the goal between 2022 and 2026. Now 27 to 30, what's the goal? A full service bank is what they're gunning to be. They're going to enhance their product suite. They're going to increase customer centricity and engagement with the customer. They're also going to do wealth management, for example, from FY29 onwards. And they're going to create better value going forward, just driving scale. Really, that's what the FY27 to 30 strategy is. Now, we'll have Pralay Mondal in just a minute, but we're going to slip into a very short break. That's, of course, a snapshot of all that we've discussed broadly to give you a perspective of CSB Bank. We'll bring in Pralay Mondal and continue this conversation. Stay with us. Well, I have the pleasure of having with me physically in studio Mr. Pralay Mondal, Managing Director and CEO of CSB Bank. It's great having you, firstly. Thank you so much for making that journey down and coming and speaking to us. Let me first start off by understanding how Q3 has gone and how Q4 is evolving for you. First, the short term, and thereafter we'll talk long term. With regard to the slippage number, you guided that 40 to 50% of the slippages will likely get recovered in Q4 itself. As well as maybe a 30 to 40 crore reversal in Q4 had already happened prior to the con call, if I've understood this right. Everything remains the same, status quo. Does anything improve versus what you've guided? Does it depreciate? Give us a sense.
Thank you. Good afternoon to your viewers, and good afternoon, Harsh, and thanks for having me here. So yes, as I said on the analyst call itself, that on the slippages side, we had a slightly elevated slippage in Q3, and there was more of technical reasons.
Yeah.
Already on the analyst call, I said that we had upwards of 30 crores we had already recovered or upgraded, and we had also guided that we'll have a much better performance in this quarter and going ahead in the next year as well. So as we are talking today, we are well on track on what we had told the analyst on the analyst call. And we are absolutely on track, if not better. So we are absolutely fine on that.
Perfect. So SBS 2022 to 2026, the goal was to become a pan-India bank. Are you satisfied with the kind of performance that you've delivered with regard to becoming pan-India, truly?
Seriously, it's like this, that if you look at it, while we are more than a 100-year-old bank, but effectively the journey is just starting now for us.
Right.
Because we went through a tech transformation in FY25, 26. In that year, in these 2 years, we have done a lot of investments. And the entire core system migration to FC with 52 surround systems and many other systems on the CMS side, on the digital side, the ServiceNow platform, all of that is coming together. And because a bank is a bank, so you have to have all solutions before you go to a customer. So we were waiting for all this transformation to get delivered, which is broadly delivered. Some of the transaction banking would get delivered in the next 3 to 4 months. And then we are starting, as we're talking, exactly on track in terms of our FY27 onwards. The scale phase, the sustain and the build phase is over. The scale phase begins in another 20-25 days. And we are all set, and we are creating a completely focused acquisition channel for on the retail side. SME is already doing well. And on the wholesale side, when we have a further discussion, I'll talk to you about how we are building the wholesale as well. And gold continues to sustain what it was doing. So overall, I think the 4 pillars of the bank all are set to scale in between FY27 to FY30, and we are absolutely on track vis-a-vis what we had guided the investors.
What are the risks, therefore? Because you also spoke in your 2022 to 2026 strategy that you're going to implement some risk mitigation measures, which you're going to put in place to ensure that 2027 to 2030, whatever risk could emanate, you're forecasting them better, and hopefully those risks don't translate to your balance sheet. How has that played out? Give us a pulse of that, because your growth of 25% plus could be very strong because you've got all these verticals going forward.
Absolutely, Harsh. You know better than me that we today live in a very uncertain world, okay? And when you wake up in the morning, you wake up to a new world. So never one can say, especially in a banking regulatory industry, that there are no risks or we have mitigated all risks, because risks are coming not necessarily from India, but from outside. And hence, the first thing I read is what happened last night, okay? Given all this scenario, I think we have sort of planned out our FY27 to FY30 pretty well. And whatever risks, see, what are the main risks which we had as a bank? Number one was we didn't have enough customers. Number two is we didn't have a full surround system and a core system which can scale the bank to a mid-sector bank. The third risk, of course, always remains is the compliance risk. And today there are a lot of issues that are happening in the even within the country in terms of cybersecurity and money mule, those kind of things, which is there where regulators are also guiding us. So we are all working on that, and I must say that we are on track and we are more than ready on each of these things. So whatever is controllable, whatever we can see as a risk is well managed. And last thing, of course, is that we have a slightly larger gold loan portfolio as we're talking, which is almost 50% of our portfolio. And that we are mitigating through larger scale in terms of wholesale, SME and retail. So we can talk about it a little bit later.
Sure. So as you grow, the goal is to get from sub 40,000 crore in terms of loan book size to 1 lakh crore plus. My first part of that question is, how confident are you of that kind of growth clip? Because it will mean that you grow at 25% plus for a significantly long period of time in banking, which is 4 years straight. And the second piece is, how does your loan mix evolve therefore? Because thereafter, will I come to yields and understand how yields and margins will evolve? But first on the growth and on the loan mix.
So this is where it starts getting interesting, let me tell you. And unlike conventional belief that as we grow the, the balance sheet, the growth comes down, for us it will be exactly the opposite. The reason being that today we have a single vehicle or at best 2 vehicles which are growing. Suddenly you will have 4 vehicles, and some of the growth in those vehicles are purely based on execution and the operating leverage which you are creating, which is a wholesale, which is a SME, which is a retail and all of these. And you know what kind of growth that can happen. And we are so small at this point of time, we can grow much faster than what we are doing. And while you are saying that, yes, more than 1 lakh crore, we hope we do much more than that, because we want to be in the mid-sector by 2030. And at a 1 lakh crore, you will not be in the mid-sector. Mark it up for inflation. So we have to do better than that. But the good part is, if we continue to grow better, and obviously with all risk mitigation in place, then on a larger balance sheet, if you grow faster, your average CAGR starts going up. This is where it gets interesting. And the kind of leadership, the kind of management, and the kind of systems which you have now, I think, and now we are becoming pan-India, distributions happening all over the country, just not Kerala, 31% branches are in Kerala. But as we grow, the rest of the south we have first concentrated. Now we are moving to north, west, east, everywhere. So I think with the distribution growth and with all the vertical franchise growing, last year we grew in wholesale by 40% plus, okay? So given that, I think we are ready, and I'd be disappointed if we look at a 1 lakh number only by 2030.
Oh, okay. You'll be disappointed. Okay, so you're sounding extremely bullish. Talk to us about margins, because that has been a pain point for you, if I can call it that, sir. You can correct me if you feel that I'm wrong. You've guided consistently that margins will hold up. At least I remember maybe a year or so back when I was listening to your con calls, you kept saying that no, margins will hold up. But they weren't holding, they were slipping. Some part of it attributable to CASA not really kick-starting for you. Talk us through that journey and what's changing now. If at all there is that confidence, what's the kind of CASA ratio one can expect in FY27, FY29, FY30?
Sure. No, I'll tell you what, margins, while we say that we'll be somewhere between 3.7 to 4% in that range, and we are slightly on the lower end of that, we are around 3.81. But I've also said that time that we will not sacrifice growth for margins, because at the end of the day, margin will go every quarter and people will not remember that. But what people will remember is what the franchise you are building for future. And hence, if your business mix starts changing, obviously the yields will have its impact. At the same time, that will help you in overall ROA because you get cross-sell, you get other businesses along with it, and banking is not a single monoline product, and all of that will build the ROA together. And also it will help us building the deposit franchise because CASA will just not happen because you're acquiring more customers. CASA will happen because if the customers are using those accounts or when wholesale is doing businesses on the collection accounts, CA and all of that stuff. So when all of this comes together, we expect our CASA ratio to start going up from FY28 onwards. By FY28, the CASA will grow at the same rate as deposits, and then it will start improving, and our overall cost of funds will start going down from FY28 onwards. Till then, I think we will have enough mix on the gold loan side, so we should be able to hold the CASA, NIM somewhere between 3.75 to 4. And we have proved that compared to Q2, we are much better off in Q3 already. And I think we should be in this range of 3.75 to 4. The other thing I must say that it's not just us alone. The overall liquidity challenge, which was there before, and now with all the global changes, the bond yields, and today, as we're talking, I was hearing that the CD rates, short-term CD rates of 3 months has gone up by another 20-25 basis points in the market. So it's not that we alone. I think the whole ecosystem is grappling with this scenario, but I think this shall also pass in my view.
Right. Your ROEs, sir, have sunk a little bit. I wanted to actually talk ROAs, but maybe ROEs is the better metric. It sunk a bit. Does it go back above 20% at some point? Because your growth will be very strong. Margins, you're saying you're willing to sacrifice. In that case, ROEs becomes the challenge, right?
So let me talk both ROA and ROE because ROEs also have a factor of what kind of CRAR you are sitting on, and hence that's a little mathematical in this. And that I think it's better to talk both ROA and ROE together.
Right.
So on ROA, I think we want to be somewhere around 1.5%. We are a little lower than that. We'll improve that because there have been a lot of investments that is going into the technology and distribution and people at this point of time. And it comes a little back-ended in terms of the results and the revenue. And on the ROA side, for us, we want to be above 15%. I think 20% will be difficult at this stage because we are building the bank. Maybe after 5 years, we can look at it. But I think we want to be above 15%. And give and take few quarters here and there, we should be there. And on ROA, we should be somewhere around 1.5%. This is what our plans are.
Lastly, very quickly, fundraise when?
We have done our calculation. I think next 2.5, 3 years, we don't need a fundraise because we are accreting a lot of profits as well.
Right.
If ROE is at a 1.5%, rest maths can do.
Perfect. Okay. Mr. Mondal, thank you so much. This has been quick, sharp, and really effective. Thank you so much for coming in and speaking with us. Viewers, I hope you enjoyed this because it was engaging. But with that, out of time on this one. Thanks so much for tuning in.
Thank you.